Imagine a company once valued at $47 billion, now worth almost nothing. How did WeWork go from history-making disruption to disaster? This isn't just a business story, it's a saga of ambition, illusion, and a spectacular fall from grace that redefined what it means to be a startup unicorn. We are going to unpack how a simple idea about office space spiraled into one of the most talked-about corporate implosions in modern history. We'll look at the charismatic leader, the billions in venture capital, and the fatal flaws hidden just beneath the surface of the hype. By the end, you'll understand the crucial lessons WeWork taught us all about the difference between a revolutionary idea and a house of cards. Let's rewind to the world before WeWork. For decades, if you wanted to start a business or needed a professional workspace, your options were rigid and frankly uninspiring. You were looking at traditional offices with long, ironclad leases, often demanding a commitment of 5 or even 10 years. This model was a nightmare for small businesses, freelancers, and startups. It required a huge upfront capital investment for deposits, furniture, and utilities, locking you into a space you might outgrow in 6 months, or worse, couldn't afford if business slowed down. The office was just a place to work, a beige box with a desk and a phone line. There was no soul, no community, and certainly no flexibility. The system was broken, especially for the new generation of entrepreneurs who valued agility and connection over long-term stability. The market was ripe for a shakeup, crying out for a solution that understood the modern workforce. Someone needed to tear down the old walls, both literally and figuratively, and then along came Adam Neumann and Miguel McKelvey with a big disruptive idea. In 2010, they launched WeWork, but their vision went far beyond just renting out desks. They weren't selling office space, they were selling a lifestyle. They positioned WeWork not as a real estate company, but as a community, a global network of creators. The promise was intoxicating. Join WeWork and you weren't just getting a desk, you were getting access to a built-in professional network, free-flowing coffee and beer, and an energetic, collaborative culture. This was the future of work. Their mission was to create a world where people work to make a life, not just a living. It was a brilliant piece of branding that transformed a mundane utility, office space, into an aspirational product. For startups and freelancers, this was the dream. You could scale up or down on a monthly basis, plug into a vibrant community, and feel like you were part of something bigger. WeWork promised to handle the boring stuff so you could focus on changing the world. So, how did this vision explode into a multi-billion-dollar behemoth? The strategy was a masterclass in aggressive growth, fueled by a narrative that captivated investors. First and foremost, WeWork brilliantly branded itself as a tech company. This was the key move. Real estate companies are valued based on tangible assets and predictable cash flow, which typically means lower valuations. But tech companies, they're valued on potential, on scalability, on the promise of future disruption. By calling themselves a space-as-a-service platform and emphasizing their proprietary app and global network, WeWork convinced investors, most notably SoftBank's Masayoshi Son, that they were the Amazon of office space. This tech label unlocked access to staggering amounts of venture capital, billions of dollars that were immediately poured into hyper-aggressive expansion. WeWork started signing long-term leases on prime real estate in the world's most expensive cities, then quickly renovated them with their signature glass walls, neon signs, and communal lounges. They weren't just opening new locations, they were launching them with the fanfare of a new iPhone release. The marketing was relentless, focusing on the aspirational lifestyle, the parties, the networking events, and the cult-like we philosophy. They sold the sizzle, not the steak. The strategy wasn't to be profitable in the short term, it was to achieve global domination at any cost. Grow fast, capture the market, and worry about the profits later. A classic Silicon Valley playbook, but one that was dangerously misapplied to a fundamentally old-school business. But behind the kombucha on tap and the glowing hustle harder signs, the cracks were starting to show. The fundamental business model was precariously imbalanced. WeWork was locking itself into long-term, multi-year lease obligations with landlords, often for 10 to 15 years. Meanwhile, its revenue came from short-term memberships, with many tenants on month-to-month contracts. This created a massive asset-liability mismatch. If an economic downturn hit, tenants could flee overnight, but WeWork would still be on the hook for billions in rent for years to come. It was a high-wire act with no safety net. Then there was the valuation bubble. At its peak, WeWork was valued at $47 billion. To put that in perspective, that was more than established real estate giants like Boston Properties, which actually owned its buildings and was consistently profitable. WeWork's valuation wasn't based on its financials, which were bleeding red ink, but on the story it told. This disconnect was enabled by its charismatic and unpredictable co-founder and CEO, Adam Neumann. His grand, often erratic vision and cult of personality mesmerized investors, but his leadership style also led to questionable decisions, conflicts of interest, and a corporate culture that prioritized growth and partying over fiscal discipline. The company was burning through cash at an alarming rate, spending lavishly on acquisitions and expansion, all while racking up staggering losses. The hype was a powerful engine, but it was running on fumes. The house of cards came tumbling down in 2019. In August, WeWork filed its S-1 paperwork to go public, a document that gives potential investors their first official look under the hood of a company. The reveal was a disaster. The filing exposed the jaw-dropping scale of the company's losses, nearly $2 billion in 2018 alone. It also laid bare the bizarre corporate governance, the complex financial arrangements, and the numerous conflicts of interest involving Adam Neumann, who had personally profited from leasing buildings he owned back to WeWork. The emperor had no clothes. Wall Street, which had been swept up in the private market hype, took one look at the numbers and recoiled. The tech company narrative evaporated overnight, and WeWork was seen for what it was, a high-risk real estate company with a dangerously unsustainable business model. The planned IPO was shelved, the valuation plummeted from $47 billion to under $8 billion, and Adam Neumann was ousted as CEO, albeit with a golden parachute worth over $1 billion. The fall was as swift and dramatic as the rise. So, what can we learn from this epic corporate flameout? The core lesson is the critical importance of sustainable growth over manufactured hype. WeWork serves as a powerful reminder that no amount of branding, charisma, or venture capital can defy the fundamental laws of business economics. You still need a viable path to profitability. It also highlights the crucial difference between genuine innovation and a compelling illusion. WeWork did innovate by making commercial real estate more flexible and community-oriented, but it wrapped that innovation in a fantasy. The fantasy of being a world-changing tech company that could ignore its massive losses. For today's startups and entrepreneurs, the WeWork saga is a cautionary tale. Focus on building a solid business foundation, not just a seductive story. Valuation is a metric, not a mission, and a healthy, disciplined corporate culture is far more valuable than a culture of excess. The human element of this story is just as compelling. In the early days, WeWork was a haven for countless freelancers, artists, and small startups. For a reasonable monthly fee, they got a beautiful office, a vibrant community, and the flexibility to chase their dreams without being shackled by a 5-year lease. Many of these early members thrived, building successful businesses from within WeWork's glass-walled ecosystems. They were the living embodiment of the company's initial promise. But on the other side of the coin are the landlords and even entire cities that were burned by WeWork's collapse. When the company filed for bankruptcy in 2023, it walked away from dozens of leases, leaving landlords with huge, empty buildings and cities with vacant commercial space that cratered local property values. It was a stark reminder that the fallout from such a massive failure ripples far beyond the company's own employees and investors. Despite its spectacular failure, WeWork's impact on the industry is undeniable. It permanently changed our expectations of what an office can be. The idea of flexible leases, beautifully designed common areas, and community-focused amenities is now standard in the coworking industry. WeWork was the disruptor that forced traditional landlords to innovate and offer more flexible, tenant-friendly options. Furthermore, its popularization of the space-as-a-services model helped lay the cultural groundwork for the remote and hybrid work revolution that accelerated during the pandemic. In a strange way, WeWork's vision of work as something fluid, decentralized, and community-based was prophetic. It just failed to build a sustainable business to support that vision. The industry it helped create is now thriving, but it's a more mature, realistic version, one that prioritizes profitability over growth at all costs. What do you think? Was WeWork a visionary idea ahead of its time, or just a cautionary tale of startup hype? Let me know in the comments. Don't forget to subscribe for more business deep dives.